Hello, fellow traders. 'Tis I, the Rumpled One. Sunday, November the 19th, the year 2017. Weekly gap and open. As you can see here, according to the dashboard, we only have a few that haven't filled the gap already. A couple of the New Zealand pairs, the yen and the dollar. And we also have the euro pound not filling the gap. Everything else, the gap is filled. For those just tuning in, the weekly gap happens when the market opens after the Friday close. When it opens on Monday, there's usually a gap between the current open for the week, the weekly open, and last week's close, or the previous week's close. And usually that gap gets filled so we can exploit that. So as you can see here, let's switch over to New Zealand. You can see that there's that gap. It gapped down 16, and it still has about 11 pips to go to fill that gap. And the New Zealand yen, let's see, looks like that gap down 15, and it has about 9 pips to go to fill it. So we'll come back and check on Monday, Tuesday, the rest of the week to see if that gap gets filled. Now, I had a question come in, and it was about the buy zone and the weekly open crossover buy zone, and they wanted to know, when they're trading the weekly open cross, where do you set your stop loss? Well, there's many ways you can do it. You can use the buy zone. That's one method, but I think when you're in the trade, I think there might be a slightly better way, and that is if you just look at the price action. So might take a minute or two to switch over to M5 New Zealand yen, because I probably don't have that data loaded on the computer. So let's look at right here. We see this weekly open. So let's say price came down here and you went short, and then all of a sudden you see you may have picked up a few pips profit, but you hung in. It came back, and right here it didn't make a new low, and then price started to reverse. Well, you could have exited, but let's say you hung in, you thought, well, maybe it'll keep going down, but then you can see right here it broke that high. Price actions telling you we've got a higher low and a higher high. Probably time to get out. Now maybe you said, let's just let that candle close. Let's let this bull candle close. And you did. And you see here it broke it a second time. How many times do you need to be told that price is going up? Because you see it went down, higher low, and then it broke the high. So where do you place the stop loss? Well, let's see. Look at the high of the candle where you entered, or maybe the candle before. In either case, you can use price action when you're trading the weekly cross. And you see here, once again, it came down, but it didn't even make a lower low. So you made a higher low in comparison. And then it turned right back around, and you can see once again where it crossed over. Now you said, well, maybe if I would have taken your advice here, I would have put my stop loss here. Well, I don't know if that would be prudent. Because even if you did do that, once again, you can look here, you can see higher low, oh, broke out across that high. price is telling you to get out. You see, you'd only be down 4, maybe 5 pips. And in this case here, you'd only be out just a couple of pips, just using the price action. Now, some people say, yeah, you could get wiggled out, and that's true. But you just have to use price action. Now, I was on the M5 chart. We can look at a different time frame if you like. And let's let the buffer fill up with the data, since this isn't one of my normally or usually traded pairs. So you can see here, if you would have taken that weekly open cross, there were pips to be made. Here there were pips to be made. On this one, once again, it crossed the line, made a higher low, turned around, broke out. So maybe right here you exited. That was your stop. And once again, that would have been maybe 4 or 5 pip stop. Not too shabby. Trading price action. Keep your losses small and let your winners run. Just based on simple price action. That once again, it is that simple. So I hope that answers that question. Position size, that's up to you, but just make sure you keep the risk, the same. So if you only want to risk 1% on the trade, position size accordingly. So you can have a fixed, if you're using a fixed position size, then you adjust the stop accordingly. If you decide where the stop is, then you adjust the position size. You can go back a couple videos and I talked about position sizing and risk. So once again, not too difficult, pretty straightforward and simple. And as always, no squiggly lines were harmed in the making of this video. So we'll see you next trading session. As always, it's not what you trade, it's how you trade it. TheRumpledOne signing off to drain the banks.